Now we shall take up
sums on money market.
examples on, let's understand how exactly you're going to set up a money market hedge. And you're going to, try to maximize your cash inflow from an export, or minimize the cash outflow in case of an import, right?
Yes, sir.
Now let us go ahead and take on this example, a question numerical S.
A UK company sells products worth $1 million to a customer in USA with the payment to be made in 3 months. The following information is as follows. Current spot rate dollar per pound 1.4920-1.5020. 3 months rate per annum. For currency pound, deposit rate is 5.3 by 32% and borrowing rate is 5.3 by 16%. And for a dollar currency, deposit is 4.5 by 16% and the borrowings are 4.9 by 16%.
That's it.
Yes, sir. How might the company set up a money market hedge for the transaction exposure?
So now tell me, in this transaction, just tell me whether your company has a payable receivable. In this case, a UK company, it is going to sell products worth US dollar 1 million. So therefore, it's a receivable. You are supposed to receive money from the US customer. And remember, it is UK company exporting goods to USA. So here, what is your local currency?
Pound.
It is your the pound sterling, right?
Yes, sir.
GBP is your local currency, or you can say home currency. And here, what is the foreign currency involved? It is a US dollar.
Dollars.
Now, there is a problem. You exported goods worth US dollar 1 million today. But you're going to get this amount from that foreign customer only after how many months? 3 months. Now, you don't know what will be the exchange rate after 3 months. Yes or no?
Yes.
So, the number of pounds you're going to get might be less. So, what you can do, you can go for a forward contract. You can book a forward contract, take a forward cover. I think we saw a few examples on taking a forward cover, right?
Yes, sir.
Or you can go for a money market hedge, or you can go for currency futures, currency options, or a currency swap. Okay. Anyway, we want to deal with other instruments later. Now let's focus on the non-derivative hedging tool, the money market hedge. Now they're given the interest rate in 2 countries, right?
Yes, sir.
They're given the interest rate in UK and in the US. Now you know that your company has a receivable, right? That means you have an asset. What happens in case of money market hedges? Very simple rule. Suppose you have an asset, a receivable, you are supposed to create a matching liability. Now, because you have a $1 million receivable in 3 months' time, you got to create a $1 million liability in 3 months' time. So don't borrow money. See what you can do here, you can borrow money in US dollars. But you should not borrow $1 million. Borrow something less today. And that plus interest for 3 months on that loan that you're going to borrow in US should be equal to $1 million. So that when you receive the money from the customer, that amount can be used to pay off the loan. Is that fine?
Yes.
And that is how a money market hedge works. Whenever you have an asset, you are supposed to create a matching liability. People ask, what about imports? When you have an import, what you have a liability, a payable. When you have a liability, you have to create an asset in that foreign currency. Simple. It is simple asset liability matching. It is a matching of, that is, when you have an asset, create a matching liability. And when you have a liability, create a matching asset. Is that fine?
Yes.
Now let us focus on this example where you have a receivable, that is, you have an asset, and you are supposed to create a matching liability. Okay.
Yes, sir.
Now let's take on this. And one more thing. And what is the interest rate in UK? In US, you tell me first.
In US, deposit rate is 4.5 by 16%, and borrowing rate is 4.9 by 16%.
They given all these rates in improper fraction, right?
Yes,
They given
sir.
4.9 by 16%. So how do you get the per? And one more thing, all these rates are always a per annum rates. Even though these are rates for a 3-month deposit or a 3-month loan, have they given that? These are per annum rates. These are 3 months rate. That means what? In case you want to deposit money in the US for 3 months, this is the rate applicable. But the rate is a per annum rate. Very simple rule. You go to your bank today. You say you want to put rupees 1 lakh. You want to place rupees 1 lakh on a fixed deposit for 3 months. They'll say the rate is 5%. But not 5% for 3 months, 5% per annum. Always remember the rates are given on a per annum basis. The rates are annualized. Okay? Even as a 3-month rate, it is a rate expressed on a per annum basis. Now, in case you want to find the 3-month rate, you should take the rate of interest into 3 by 12 or 1 by 4. So let me now, please be ready with your calculator. Now tell me, what is a borrowing rate in US? It's given as
9 by 16%.
Okay, so how do you convert this 9 by 16? So what do you do? Take a calculator. What is 9 by 16?
It's 0.5625.
Add that to 4. So I can say
4.5625.
Blah 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 is what? Is a percentage on a loan that you're going to borrow. But how to find the 3-month rate? This into 3 by 12. This number into 3 by 12. How much you get?
1.1403.
Okay, percent. But how do you convert decimal divided by 100? Because this is a percentage. It's 1.140625 whatever percent. So divided by 100 will give you the decimal.
0.1140625.
And so on, right? Yes. You get it. And that is how you get the rate for 3 months. And you can convert the rate into decimal, not an issue at all. Fine?
Yes, sir.
Got it? Now let us understand how exactly you're going to go about when you have an asset in brackets receivable. Now how do you go about Hedge? What is that? Money Market Hedge. Okay. Let's take on the solution. Let's discuss each step. And I want people to plot that or jot down the solution in your notebook, each step, okay?
Yes.
Step number 1.
Step number 1 is a borrow or say create liability within brackets.
You saw that because you have an asset, you are supposed to create a liability. What are you going to do? Your company can borrow in the US today, but borrow in such a way that the amount borrowed plus interest on that borrowing for 3 months should be equal to how many dollars? $1 million.
$1 million.
So that when you receive the money from the customer, you can use that money to pay off this loan. So you don't have to bother about the loan. Once your customer pays the money, you can use that money to pay off the loan, right?
Yes, sir.
So borrow in brackets what?
Create liability.
Create a liability under that.
So the company will receive $1 million in 3 months. So to create a hedge, it can borrow $1 now for 3 months. Now the amount borrowed plus interest will be paid at the end of 3 months, and the loan plus interest would add up to $1 million.
1 million.
So that the future dollar income will be exactly the amount required to pay the liability.
You saw the future dollar income is nothing but the receipt. Now once you receive that $1 million from your customer, that income, that money can be used to repay the loan with interest. Next.
Or if the future income is F, the amount borrowed now should be F divided by 1 plus R.
Basically, finding out the present value of $1 million. Remember, since F is what? In which currency is in dollars. the denominator R has to be the rate for dollars. But which rate? Since you're going to create a liability, take the borrowing rate. So F divided by 1 plus R. Next.
Now, where R is equal to amount of interest charged, here the company could borrow for 3 months at an annual rate of 49 by 16%, but the interest charged only for 3 months.
3 months.
Is 1.140625%. So the value of 1 plus R is therefore 1.01140625.
So 1 plus R will be in decimal format. You all know that, right? To find the discount factor. So $1 million divided by 1.0114 625. So how many dollars you got to borrow?
We got to borrow $988,722.
That's it. You got to borrow $988,722. Or if you're comfortable, you can say $988,722 will be borrowed today. So that this amount borrowed on this interest for 3 months will be exactly equal to $1 million. Is that fine?
Yes, sir.
So that is step number 1. You are supposed to create a liability. For that, borrow in that foreign currency. Because you have a foreign currency asset that is receivable, you got to create a foreign currency liability and obligation. So that you borrow, create a liability. That is step number 1. Okay. But let's first you jot down this, then I'll tell you what to do with the borrowed money. Because you're going to get how much when you borrow? You'll receive, when you borrow in the US, you'll be having $988,720 with you. I'll tell you what to do with those dollars, okay?
Yes, sir.
Keep it safe. Yes. Just pause the recording and jot down the...
Finish reading. So borrow $1 million divided by 1.01140625, which is equal to $988,722 at 1.140625%.
Okay.
Now in 3 months you will owe $1 million exactly, which will be settled out of dollar receipts from the customer.
Now please go ahead and jot down step number 1. Okay, but in the examination, please remember, don't write all this story, okay? Yeah. You straight away write the heading, step number 1, borrow, create a liability. Under that what? Straight away write the formula. P is equal to, what is P? The present value. P equals F divided by 1 plus R. That's it. And then you compute the number and write down 988,722. Don't say that in 3 months' time this will become $1 million. With that I'll pay. All those are not required from examination. So examination, step number 1, borrow, create a liability and write down that formula F divided by 1 plus R. And that is the amount to be borrowed. Done. Full stop. Is that fine?
Yes, sir.
But since you are trying to understand the subject, please take down the entire thing in your notebook. The entire para, the theory, right?
Yes, sir.
Now please go ahead. And one more thing before you can take down this example and step number 1, I want people to write down even the methods of
hedging.
Hedging, transaction, exposure. Make that flow chart. And also what? Write down the question. And step number 1 you copy. Is that fine?
Yes.
Okay, now let us go ahead and take on step number 2.
Yes, sir.
So you have a $988,722 borrowed, right, with you?
Yes.
Now, what you will do with those dollars in the UK? What are you going to do? You can sell those dollars, which is a variable currency in the quote. Yes or no? They look at the quotation given spot exchange rate. I think they're given dollars per pound, right?
Yes.
It is so many dollars for 1 pound. Now remember, you're going to have, once you borrow the money, you're going to have, you'll be having $988,722 in your hand. So you can sell those dollars. That is, you're going to sell the variable currency in the quote and then turn them into GBP, pounds, right?
Yes, sir.
So that is step number 2. That is, you got to convert, or rather you should sell that foreign currency loan, that is, which is in dollars in this example, into pounds, your local currency, or I say home currency, right?
Yes,
yes ma'am. Step 2.
Like step 2, convert. Exchange the borrowed dollar into pounds immediately at the spot rate of 1.5020. The exchange of a pound received now will be $9,88,722 divided by 1.5020. Pound 6,58,270.
Did you all notice that we use a sell rate? Now, since you're going to sell the variable currency in the quote, you want to take the sell rate and divide, apply the rule, right?
Yes.
So it is 9,88,722 US dollars divided by 1.5020. And how many pounds you get?
6,58,270 pounds.
This is the number of pounds you'll get from the banker to whom you want to sell these dollars, right? To a forex dealer. Example, a banker. Now, when you sell these dollars, you'll get these many pounds with you, right? That is step number 2. And be safe, okay? Just hold those pounds with you. I'll tell you what to do in step number 3 with those pounds, okay?
Should I read some?
Let's complete step number 3 also.
Yes. Now, invest and harvest.
That's a fancy term, okay? So remember, we assume the in the real world, the 6 lakh, how much?
58,270 pounds.
These pounds will be used in the business to meet the working capital need, right?
Yes.
But for examination purpose, we have to assume that what if these pounds are invested for 3 months? People ask me, why not 6 months? Why not 4 months? I'm taking 3 months because you are supposed to get this money in how many months? The $1 million, 3 months time. I want to find what is the worth of these pounds in 3 months time so that I can compare this outcome with a forward contract. Had I booked a forward contract to sell the $1 million in 3 months time, how many pounds I would have got? So that I can compare these two and say which is better. Should I go for a forward contract or should I go for a money market hedge? Is that fine? Now, for that purpose, we assume that the pounds, that is the local currency, will be invested in the UK. Now, tell me, go back to the question, tell me what is the deposit rate in UK? What is the deposit rate in the UK? It is
5.3 by 32%.
5.3 by 32. Take a calculator. Now, what is 3 by 32? 3 by 32.
It is 0.093.
And add 5 to it, 5.09 something. That into 3 by 12.
1.273437.
That is a percentage for 3 months. If you want, you can turn this into decimal divided by 100.
0.01273437.
That's it. You know, that is the interest will earn on the 6 lakh, how much? 50?
8,270 pounds.
270 pounds. You earn this much interest for 3 months. Is that fine?
Yes, sir.
That's why I given heading step number 3, invest and harvest. Or simply write invest. That will do. Even just invest, that will do. Anyway, you're going to harvest. After 3 months, you'll go and draw the money from the bank. Right?
Yes, sir.
So invest. The local currency, what you got in step number 2. What is step number 1? Borrow in foreign currency. Make it clear. Step 2, you convert the foreign currency loan into local currency, or you can say home currency. Step 3, invest the home currency. For how many months in this example? 3 months. Why? It's a 3-month receivable. Had it been a 6-month receivable, then what? Invest for 6 months. Is that fine?
Yes.
Yes, ma'am.
So the sterling pound income can be used in the business now. However, for comparative purpose, an exam question might ask you to calculate what the company would earn if it had put the sterling receipts on deposits for 3 months period.
When they say sterling receipt, the pound, the GBP is a pound sterling. If that is invested for 3 months, what is the income?
The pound deposit rate for 3 months is 5.3 by 32% per annum, which is 1.2734375% for a 3 months period. An amount deposited now P will increase in value to P into 1 plus R at the end of deposit period.
It is P into 1 plus R. Suppose you invest P amount, that into 1 plus R. will be the worth of that money in 3 months' time. Yes, ma'am.
Where R is the rate of interest earned for the deposit period.
Mhm.
Now here, although the annual interest rate is 5.3 by 32%, the actual amount earned over 3 months period is 1.2734375%. So 1 plus R is equal to 1.012734375. After 3 months, this amount with interest would have increased in value to pound 6,58,270 into 1.012734375, which is pound 6,66,653.
This is a worth or value of your investment in 3 months' time with interest, right?
Yes, sir.
This is your pound receipt or income in 3 months' time. Now, why do you compute this? So that this number can be compared with, had you taken a forward contract to sell the $1 million in 3 months' time, you have to see how many pounds. Here they haven't given the forward rate.
Yes.
But had they given the 3-month forward contract rate, I'll see how many pounds I'm getting in 3 months' time. Then I can compare both and decide whether to go for a forward contract or money market hedge. Okay, I can decide.
That's it.
That's it?
Yes.
Now, please go ahead and jot down step number 2 and step number 3. Make it very clear. Step 1 is what?
It's
Borrow in foreign currency. Very important. So, because you have a foreign currency asset, step number 1, create what? Borrow in foreign currency means create a foreign currency liability. Step 2, what? Please convert the foreign currency loan into local or say home currency. And step 3, invest the home currency. These are the 3 steps you follow whenever you have what? A foreign currency asset.
Receivable.
That is a receivable. These are the 3 steps you follow in money market hedge. That's it. Any sum doesn't matter. Doesn't matter what are the 2 currencies. Here it's dollars and pounds. Doesn't matter whether it's dollars and rupees. The same 3 steps will follow whenever you have a foreign currency asset. First step, create a foreign currency liability. Step 2, convert that foreign currency loan into your local currency or home currency. Third step, what? Invest the home currency. And see what is the worth of that investment in 3 months or 6 months, depending on whether it's a 3-month receivable or 6-month receivable, right?
Yes.
That's it. Now, please go ahead and jot down the solution.